Well, let's discuss one sector now, tires, and how that is going to pan out. It was a bad year for FY11, and let's see if FY12 is going to be any different. We have Arnab Banerjee, ED of CEAT now joining in. Arnab, afternoon, thanks for joining us. FY11 was quite bad for the industry, and also you were not insulated from that. How has FY12 begun, and going forward, do you think that you will be able to pass on some of the high rubber prices, and you will be able to report decent profits going forward?
Yeah, last year there was a margin squeeze because of significant increase in raw material, primarily rubber, but also significant inflation in crude derivatives. For example, synthetic rubber went up by 60%, natural rubber of course went up by about 40%. That trend continues. So the margin squeeze which we had experienced last year continues into this fiscal, at least the first couple of months. We have now considered this as a given trend, and we don't see this trend reversing in the near future. Hence, at CEAT our strategy is primarily based on moving aggressively towards acquiring market share in more value-added product mix, both in domestic market as well as in export market, where the CEAT brand commands a premium, and last year we bought over the global rights of the brand from Pirelli for the same purpose. So our strategy is primarily going to be based on the assumption that the raw material situation is going to continue, as there is a fundamental issue in the market. There is a shortage of about 150,000 tons of rubber in the domestic market per annum.
Okay. Well, just a brief digression, Mr. Banerjee. The news coming in that cement prices cut by about 5 to 15 rupees in Hyderabad for a 50 kg bag, and that perhaps is in order. It normally happens pre-monsoon and perhaps just a seasonal effect. Maybe year on year we wouldn't see much of a difference. One notices a spurt in cement prices in the months of February to March, maybe even April, and thereafter you do see this seasonal decline.
Plus this time we have seen early onset of monsoon as well, so seeing that kind of trend.
And we all know that cement capacity utilization is nothing to write home about. Well, Arnab, the point is taken that there will be pressure on margins, but compared to all your peers, the impact was a little greater on your company. Your fourth quarter was a loss of about 11 crores. Does that get corrected in the first quarter or the next?
Yeah, that is not only going to get corrected, but there will be a significant improvement in the whole product mix that CEAT is engaged in selling. We make right from scooter tires to OTR tires, so we are going to select certain segments, and we are going to move up aggressively our presence in those segments which are far higher value added than pursuing the entire product mix and having a weighted average return which is low as in the past. So as I said earlier, we cannot base our strategy based on the raw material situation which is going to be range bound, and you will see us increasingly increase our exports, increasingly increase our presence in the passenger segment in the domestic market, which is much more value added play than the product mix that we have experienced in the past at CEAT.
So how much would margins improve by given this strategy, and will that happen in this quarter itself? Complete changeover of product mix does not happen in 1 or 2 months. It takes some amount of time, because we have to overhaul the production mix, we have to overhaul the selling strategy, which started last year itself. So we expect to see significant gains through the year.
Arnab, you drive quite a bit of your revenues from commercial vehicles, and FY11 was a good year for commercial vehicles, but now we are beginning to see some sort of slowdown for commercial vehicles themselves as we start FY12. Going forward, is that a concern that the revenue rate may not sustain, especially from the commercial vehicle side?
The revenue growth of CEAT in the commercial vehicle side is significantly based on the replacement market play rather than OEM market play. So there is a slowdown that we are seeing in the OEM segment, but the replacement market is still bullish. We are going through a good season in the summers, and the market will definitely show a single-digit volume growth, but nevertheless that's a good volume growth that we can expect in the commercial segment. So I don't see any short-term hassles in the commercial segment as such.
What will you assume by way of a rubber price average for the current year? I mean, what should an investor assume? And secondly, you have some capex plans. So what is your, how much will your total tire volume expand in FY12?
Yeah, I'll respond to the first question. As I said, we see the rubber prices being range bound. We don't expect a very sharp decline or very sharp inflation from here on. So that's a given from our perspective, and our strategy is based on that assumption. As far as your second question goes, our investment continues in the value-added area of passenger vehicles. We are also investing with outsourced partners in the value-added area of two-wheeler tires. We are also investing in the truck and bus radial tires. So the overall production mix will improve significantly towards higher margin, higher value-added products. And if you ask for an overall volume growth, it will be substantial in this financial year.
Will you be doing anything to rejig your debt or equity? Because interest costs have been going up 23 crore a quarter in the last reported quarter.
Yes, it is going up. So there is no immediate short-term plan to look at the financial structure of the debt-equity ratio.
All right, we'll leave it at that. Arnab Banerjee, thank you very much for sparing time for us today. That's the word coming from CEAT. Well, let's shift focus back to one of the big events that's happening in the city.